Hello everyone, welcome to EPK Capital's daily brief video. In this series we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Major index performance. Let's start with where markets closed on Monday, September 23rd. It was another record-setting day for US equity markets, with investors continuing to digest the Federal Reserve's aggressive rate cut from last week. The S&P 500 gained 0.28% to close at 5,718.57, marking yet another all-time high. This represents the index's fifth winning week in the last 6, showcasing remarkable resilience in what's historically the stock market's worst week of the year. The Dow Jones Industrial Average advanced 0.15% to 42,124.65, also setting a new record close. This follows Friday's record finish, demonstrating the blue chip index's continued momentum. Meanwhile, the Nasdaq Composite rose 0.14% to 17,974.27, with tech stocks participating in the broader rally despite more modest gains. Across the pond, European markets painted a different picture. The FTSE 100 in London fell 1.2% to 8,229.99, while Germany's DAX declined 1.5%. European markets struggled with disappointing economic data and concerns about the region's growth trajectory. In Asia, we saw mixed performances. Japan's Nikkei 225 gained 1.5% to 37,723.91, while Hong Kong's Hang Seng rose 1.4% to 18,258.57. The Chinese Shanghai Composite remained flat at 2,736.81, though this was before the major stimulus announcements that would dominate headlines. Federal Reserve developments. The dominant theme continues to be the Federal Reserve's monetary policy stance following last week's surprise 50 basis point rate cut. Multiple Fed officials took to the airwaves on Monday to defend and explain the central bank's aggressive move. Chicago Fed President Austin Goolsbee made perhaps the most notable comments, advocating for significant rate cuts to protect the labor market. Goolsbee, who supported the recent half-point cut, stressed that the central bank should act proactively rather than wait for labor market deterioration. He emphasized that interest rates remain hundreds of basis points above neutral and need to come down over the next 12 months. Boston Fed President Susan Collins and Kansas City Fed President Jeffrey Schmid also voiced their support for the 50 basis point reduction, citing progress on inflation and cooling labor market conditions as justification for the larger cut. The Fed officials' comments seemed to reassure markets about the central bank's commitment to supporting economic growth while managing inflation. Current Fed funds futures suggest a 26.6% chance of another 75 basis points of cuts through year-end, up from 23.6% on Friday. Looking ahead, traders are pricing in approximately 74 basis points of additional cuts by December, with markets appearing more balanced between expecting gradual quarter-point moves versus another large 50 basis point reduction. 6. China's historic stimulus package. The biggest macro story of the day came from China, where the People's Bank of China unveiled its most aggressive stimulus package since the COVID-19 pandemic. This coordinated policy response sent shockwaves through global markets and represents a significant shift in Beijing's approach to economic management. PBOC Governor Pan Gongsheng announced a comprehensive stimulus blitz that includes multiple powerful measures. The central bank cut the 7-day reverse repo rate by 20 basis points to 1.5%, surprising markets that expected smaller, gradual adjustments. Additionally, the reserve requirement ratio was reduced by 0.5%, freeing up approximately 1 trillion yuan or $142 billion in liquidity. Perhaps most significantly for equity markets, the PBOC announced 500 billion yuan in liquidity support specifically for Chinese stocks. This facility provides funds and brokers access to central bank liquidity to purchase equities, representing an unprecedented direct intervention to support the stock market. The package also included targeted support for the struggling property sector, with down payment ratios for second homes cut from 25% to 15% and lower mortgage rates for existing loans. While the property market impact may be limited given current sentiment, these measures signal Beijing's commitment to stabilizing this crucial sector. The announcement was followed by a rare Politburo meeting on September 26, where President Xi Jinping's government emphasized stabilizing property prices and boosting domestic consumption. This represents the first time Chinese leadership has committed to preventing further property price declines, marking a significant policy pivot. The urgency behind these measures becomes clear when examining China's economic indicators. Youth unemployment reached record highs this year, companies are engaged in intense price wars leading to layoffs, and deflationary pressures are mounting. Former central bank chief Ye Gang had warned about the need to bolster demand to prevent prolonged deflation. European Central Bank policy. European monetary policy remained in focus as markets digested the ECB's recent rate cut and contemplated future moves. On September 12, the ECB delivered its second rate cut of the year, lowering the deposit facility rate by 25 basis points to 3.50%. The decision was driven by weakening inflationary pressures and sluggish economic growth across the Eurozone. Eurozone inflation fell to 2.2% in August, its lowest level since July 2021, while core inflation declined from 2.9% to 2.8%. Economic growth data proved equally concerning, with Eurozone GDP growing just 0.2% in the second quarter, revised down from an earlier estimate of 0.3%. Germany, the region's largest economy, actually contracted by 0.1%. The ECB's updated economic projections, released alongside the rate cut, suggested potential for further easing measures as policymakers grapple with persistent economic headwinds. Markets are pricing in additional rate cuts as the central bank seeks to stimulate growth while managing inflation expectations. Bank of Japan holds steady. In contrast to the easing bias from other major central banks, the Bank of Japan maintained its cautious approach to policy normalization. On Friday, September 20, the BOJ kept its benchmark interest rate steady at around 0.25%, the highest level since 2008. The decision came as the central bank continues its delicate transition away from ultra-loose monetary policy. In its statement, the BOJ noted that Japan's economy is recovering moderately, though it acknowledged some areas of weakness. BOJ Governor Kazuo Ueda has indicated the central bank would pursue further rate hikes if economic conditions and inflation align with forecasts. This hawkish stance distinguishes the BOJ from other major central banks pivoting toward easing. Recent data showed Japan's core consumer price index rising 2.8% year-on-year, supporting the BOJ's view that inflation is sustainably moving toward its 2% target. However, revised GDP data showing slower than expected growth in the second quarter has complicated the policy outlook. The timing is particularly sensitive with Japan's Liberal Democratic Party leadership election scheduled for September 27, where the winner is expected to become the new prime minister in early October. Geopolitical developments. On the geopolitical front, the ongoing conflict between Russia and Ukraine continues to influence market sentiment and global economic dynamics. Ukrainian President Volodymyr Zelensky made significant statements on Monday, telling ABC News that Ukraine is closer to the end of the war than many realize. Zelensky emphasized that decisive actions by the United States could hasten the war's conclusion, particularly highlighting how Ukraine's Kursk offensive has exposed vulnerabilities in Putin's position. He is very afraid, Zelensky said, referring to Putin's reaction to Ukraine's ability to operate within Russian territory. The conflict's economic implications remain substantial, affecting global supply chains, energy markets, and food security. European markets, in particular, continue to face pressure from elevated energy costs and supply chain disruptions stemming from the war. In the Middle East, tensions continue to simmer with ongoing concerns about regional stability affecting oil prices and global risk sentiment. While crude oil has declined recently, geopolitical risks remain a key factor in energy market dynamics. Political commentary and market impact. The political landscape provided additional market-moving commentary on Monday. Former President Donald Trump made headlines with his threats regarding trade policy, specifically targeting John Deere with potential 200% tariffs if the company moves production to Mexico. Trump's comments, made during a campaign event in Pennsylvania, sent ripples through industrial and agricultural equipment sectors. He warned that John Deere would face severe tariffs if they proceed with planned production shifts to Mexico, stating, "If they do that, we will put a 200% tariff on everything that they want to sell into the United States." These protectionist policy signals highlight the ongoing political debate around trade policy and manufacturing competitiveness, themes that continue to influence investor sentiment regarding multinational corporations and global supply chain strategies. On the Democratic side, Vice President Kamala Harris made her first significant public statement on cryptocurrency policy during a Wall Street fundraiser, pledging support for investment in AI and digital assets. This marked a notable shift in tone from the current administration's previously cautious approach to digital assets. Harris emphasized a balanced approach to innovation and consumer protection, which crypto markets interpreted positively as suggesting more supportive regulatory framework under a potential Harris administration. Cryptocurrency market movements. The digital asset space showed robust performance on Monday, with major cryptocurrencies posting significant gains amid improving macro conditions and political developments. Bitcoin regained the crucial $64,000 level, trading 1.3% higher at $63,703 as of Monday afternoon. The world's largest cryptocurrency benefited from several positive catalysts, including continued inflows into spot Bitcoin ETFs totaling $397.04 million over the past week. The Federal Reserve's rate cut continues to provide a supportive backdrop for risk assets including cryptocurrencies. Lower interest rates reduce the opportunity cost of holding non-yielding assets like Bitcoin, while also increasing liquidity in the financial system. Ethereum showed even stronger performance, gaining 3% to trade at $2,656, successfully moving above the psychologically important $2,600 level. ETH has registered impressive gains of nearly 18% over the past week, reflecting renewed optimism in the broader crypto ecosystem. The political developments also provided support, with Vice President Harris's crypto-friendly comments being interpreted as potentially signaling a more supportive regulatory environment. This represents a significant shift from the current administration's previously skeptical stance toward digital assets. Among altcoins, BitAnswer, TAO, emerged as the day's standout performer, surging 23.32% to reach $575.60. Sui followed with gains of 13.33% to $1.62, while Solana showed more modest performance, declining 0.64% to $146.63. The global cryptocurrency market capitalization jumped 1.26% in the past 24 hours to reach $2.23 trillion, with total market volume surging 31.29% to $59.13 billion. This increased activity reflects growing institutional and retail interest following the Fed's dovish pivot. Bitcoin's dominance stood at 56.59%, up 0.16% in the past 24 hours, suggesting that while the broader crypto market is performing well, Bitcoin continues to lead the rally. Looking ahead, crypto analysts are pointing to several supportive factors including the potential approval of options trading for BlackRock's spot Bitcoin ETF by the SEC, which would represent another step toward mainstream institutional adoption. Individual stock movements. Several individual stocks made notable moves that warrant attention. Intel shares surged 3.3% following reports that Apollo Global Management is considering a multi-billion-dollar investment in the struggling chipmaker. This follows earlier reports of acquisition interest from Qualcomm, suggesting renewed confidence in Intel's turnaround potential. Tesla was among the day's top performers in the S&P 500, rallying 4.9% amid optimistic delivery forecasts ahead of the company's robotaxi event scheduled for October. The electric vehicle leader continues to benefit from investor enthusiasm around autonomous driving technology and AI applications. These individual stock movements reflect broader themes of technological innovation and strategic consolidation that continue to drive market dynamics. Economic data and indicators. Monday's economic data provided mixed signals about the health of the U.S. economy. The S&P S&P Global Purchasing Managers Index surveys showed that while business activity in the US remained robust in September, there was a slight decline from previous levels. The services sector continued to outperform manufacturing, with service providers reporting exceptional demand, according to Jose Torres, senior economist at Interactive Brokers. However, manufacturing showed signs of further deterioration, highlighting the ongoing weakness in this sector. These mixed signals support the Federal Reserve's measured approach to further rate cuts, suggesting the economy remains resilient enough to handle gradual monetary tightening normalization while showing some areas of concern that justify continued accommodation. Bond market developments. The bond market provided important signals about investor expectations and risk sentiment. U.S. Treasury yields remained relatively stable, with the 10-year yield declining to 3.741% and the 2-year yield falling to 3.58%. The yield curve dynamics continue to reflect expectations of further Fed easing, with shorter-term rates declining more sharply than longer-term rates. This uninversion of the yield curve is seen as a positive development, suggesting reduced risk of economic recession. European government bond yields also reflected the region's economic challenges, with investors seeking safety amid concerns about growth prospects and the effectiveness of ECB policy measures. Sector performance analysis. Monday's trading revealed important sector rotation patterns that provide insight into investor sentiment and economic expectations. Utilities and financial services sectors, which are sensitive to interest rate changes, continued their recent outperformance as markets anticipate further Fed accommodation. As noted by analysts at Bespoke Investment Group, 4 sectors within the S&P 500 are currently outperforming the broader market in 2024, up from just 2 sectors in July. This broadening participation suggests a healthier market structure and reduced concentration risk. The expansion beyond mega-cap technology stocks into cyclical and rate-sensitive sectors indicates growing investor confidence in the durability of the economic expansion and the effectiveness of Fed policy support. Currency market dynamics. Currency markets reflected the divergent monetary policy stances of major central banks. The US dollar faced pressure against major currencies as markets priced in additional Fed rate cuts, while the Chinese yuan strengthened following Beijing's aggressive stimulus measures. The euro showed mixed performance against the dollar as investors weighed the ECB's easing bias against ongoing economic challenges in the eurozone. The Japanese yen remained relatively stable despite the BOJ's decision to hold rates steady. These currency movements have important implications for global trade, corporate earnings, and commodity prices, particularly as we head into the final quarter of the year. Commodities and energy. Commodity markets showed mixed performance, with gold reaching new highs in US dollar terms, reflecting both safe haven demand and currency debasement concerns amid global monetary easing. Gold's strength continues to be supported by central bank buying and investor hedging against inflation and geopolitical risks. Oil prices remained under pressure, with Brent crude falling below the $70 mark momentarily before recovering to around $74.49. The decline reflects concerns about global demand growth, particularly from China, despite the recent stimulus announcements. The divergence between precious metals and energy commodities highlights different investor concerns about inflation, growth, and geopolitical risks in the current environment. Market outlook and risk factors. Looking ahead, several key factors will likely drive market performance in the coming days and weeks. The effectiveness of China's stimulus measures will be closely watched, particularly their impact on global growth expectations and commodity demand. In the United States, upcoming economic data including the Conference Board's Consumer Confidence Index and the Richmond Fed's Manufacturing Index will provide additional insight into economic momentum. Friday's PCE price index reading, the Fed's preferred inflation measure, will be particularly important for monetary policy expectations. Analysts at Crossmark Global Investments warn that while recent Fed actions have supported market momentum, any signs of accelerating economic weakness could make markets particularly sensitive to negative news. The combination of elevated valuations and high expectations creates potential for increased volatility in global market integration. The events of Monday, September 23, demonstrated the increasing interconnectedness of global financial markets. China's stimulus announcements rippled through Asian equity markets, influenced commodity prices, and affected currency dynamics worldwide. Similarly, Federal Reserve communications continue to have global implications, affecting emerging market capital flows, dollar funding conditions, and international monetary policy decisions. The synchronized nature of central bank policies, with some easing and others normalizing, creates complex cross-currents in global markets. Conclusion and key takeaways. September 23, 2024, proved to be another eventful day in global markets, characterized by continued record-setting performance in U.S. equities, historic stimulus measures from China, and ongoing policy divergence among major central banks. The key themes that emerged include the Federal Reserve's commitment to supporting economic growth through continued rate cuts, China's aggressive pivot towards stimulus measures to combat economic weakness, and the ongoing normalization process in Japan despite global easing trends. Cryptocurrency markets benefited from improved macro conditions and more supportive political rhetoric, while individual stocks reflected ongoing themes of technological innovation and strategic consolidation. As we move forward, investors will need to navigate an environment characterized by supportive monetary policy, geopolitical uncertainties, and varying regional economic conditions. The effectiveness of policy interventions, particularly China's stimulus package, will likely be a key determinant of global market performance in the coming months. The day's events underscore the importance of staying informed about global macro developments, as policy decisions in major economies continue to have far-reaching implications for asset prices, currency values, and investment opportunities worldwide. That concludes today's comprehensive market briefing. Stay tuned for tomorrow's update as we continue to monitor these developing stories and their impact on global financial markets.